Well, hello everyone. Welcome back to the Clara CFO Group channel. And if you've been here for a while, you might recognize that I'm in a different space. I am super excited to be in my new office. So I actually have rented out an office space. I've built out a little bit more behind me. So if you're new here, go back and look at our old videos and you'll see that there was a slightly different or way different background, but I'm still kind of filling in some spaces, but I can say I'm really excited to be here and to be in this new space that is going to be dedicated for recording. Hopefully I will get a lot more videos out to you guys with this dedicated space. So very, very excited about that. But that's not what this video is about. This video is actually about loans and revolving lines of credit. Whew, it might be more fun to talk about my office, but I also got an office puppy. So if you haven't seen that on the shorts, YouTube shorts, go and check that out. He's adorable and he will make his debut on here on one of our longer form videos at some point in time. But let's go ahead and talk about debt instruments and loans and lines of credit because that's pretty fun too. All right, let's go ahead and talk. If you have been running your business for a while, you might have run into a scenario where you might need to use some type of debt to keep your business running and to keep it flowing. And this happens all the time. There are very, very, very few businesses that never need to touch any kind of debt. So I actually think that debt can be used as a great way to propel your business forward. That's what they call leverage, when you use debt to get you to a better place. So I want you guys to understand when you might want to use a loan and when you might want to use a line of credit. And as you're trying to decide what to do in your business, this video hopefully will help you explain those things. So if you're not already subscribed to the channel, I would love to have you here. We've got lots more content coming your way. And this is just another example of something that we're trying to help you figure out how to run your business better and be more financially successful in the long run. That's what this channel is for. So if that sounds good, I'd love to have you as a subscriber. So I think the first thing that we will start with is just talking about what is a loan, and then we'll talk about what is a line of credit, and then we're going to go through kind of some key components and differences of those, and then when you would use each one. All right, so what is a loan? A loan is kind of one of the more traditional debt instruments. And when I say debt instruments, it's just kind of a way that you can use debt through like a bank or some type of lending agency. So we probably all have some experience with loans, especially on our personal side of our finances. So you might have a mortgage, that would be a traditional loan. You might have a car loan, another traditional loan. So loans are when you get money to buy something, or you might just get the cash into your business, and it's a set amount, so you get all of it up front. There can be loans that you kind of break down over time, but we're going to talk about really traditional loans right now. So you get the money, a set amount, and you have to pay it back in a set term, and you have a set payment every single month. And then you have an interest rate on that money. So you borrow the full amount and then you pay it back in installments over time. And that's almost always on a monthly installment. So with that, you get that lump sum up front and you're paying it back over time. With each payment, there's going to be a principal and an interest portion. So every time you pay, so maybe your payment is $1,000 and there might be $95 of that going to principal, and the other remainder of that could potentially be interest when you first start out, okay? So as the loan progresses, it will change how much is going to principal and how much is going to interest. Let's define principal real quick just to make sure that everybody's on the same page here. So when I say principal, that means the amount of money that you actually borrowed. So if you took a loan out for $50,000, your principal would be $50,000. And then as you pay and you make your payments, you're going to be kind of paying back a little bit of principal every time. So the amount you owe goes down a little bit every time. Okay, so I do want to hop in and talk to you guys about amortization schedules. So if you have a loan, you're going to have an amortization schedule. An amortization schedule is a very fancy word for showing you exactly each month what is interest, what's principal, and what's left over. What's interest, what's principal, what's left over. Okay, so we're gonna hop into a screen share here real quick, and I'm just gonna show you what that looks like. And you can actually hop onto this website if you want to and plug numbers in. If you don't have an amortization schedule, you can use this. It's very simple and I can show it to you. Okay, I just went to bankrate.com to get just a really basic amortization schedule. And so the $50,000 example I told you about, I'm just gonna plug that in here. So we're taking a loan for $50,000. loan term is 10 years, interest rate is 7%, and we're going to start this next month or this current month. When I plug all this information in, it runs a calculation for me on what my monthly payment would be, what the interest at the end of the loan, how much interest has been paid, and then the total cost of the loan means the principal plus the interest. And then I can show you guys, this is basically a simplified amortization schedule right here, where it says every month how much is going to principal, how much is going to interest, and what's the remaining balance. And I always like to show you guys too. Here's the CSV file of it. So you can see this is what a lot of amortization schedules look like. They're going to be done in Excel, or you might have the ability to pull them into Excel because all the formulas work nicely. But what it'll tell you is just what the payment is, that breakdown, and then what the balance is. So if you don't have an amortization schedule for a loan, you do want to try to contact your bank and figure out if you can get one, because it's really helpful, especially when we're trying to keep accurate records on our financials and you're paying back a loan. You want to make sure that you get that interest and that principal split out. Okay, so that's a classic loan. Let's talk now about a line of credit. And I'm specifically talking about, you'll hear the term revolving line of credit. So that's what we're going to be talking about here, because I see that being used most often for businesses. A line of credit is another debt instrument that you can use to access money. So you will need to go to a bank just like you would for a loan, and you'll need to request a line of credit. So when you get a line of credit, what this means is that the bank is going to basically give you access to a certain amount of money. They're going to give you, let's say it's $50,000 again. They're going to say, okay, you now have a line of credit for $50,000 once you're approved. And what that is it's a pot of money sitting there that you can draw on. And when you borrow from it, that's called like drawing on your line of credit. So you can use it as you need it. Unlike a loan where you get all the money up front and it's like in your bank account, a line of credit is like kind of a safety net almost of, maybe you don't need the money right now, but you might need to borrow a little bit of it in the future. Let's say to cover payroll. Maybe an invoice hasn't come in that was supposed to cover payroll and you need to make sure your people are paid. A line of credit is a really great instrument for that because you can borrow, let's say $10,000 from it, pay your people, and then when that invoice comes in, you can repay the line of credit. So it's pretty different from that loan structure that you get the money up front and you're paying back over time in very easy installments. With a line of credit, you can borrow and pay back and borrow and pay back. So that's kind of why they call it like that revolving line of credit. So unlike a loan, let's say it was a $100,000 loan and you have paid off $50,000 of it, you can't then go back to the bank and say, hey, I want to borrow again that extra $50,000 that I have kind of paid down. No, if you want to do that, you need a line of credit. So a line of credit will allow you to kind of have that use it and pay it back, use it and pay it back. One really important thing to note with that is that you're only paying an interest on the money that you're borrowing for the term that you borrow it for. So unlike a loan, again, where you're paying interest on that full amount because you get it all up front, if you use $10,000 for 7 days, you're only paying interest on the $10,000 for those 7 days, okay? So that's really important because you can think about using a line of credit very strategically and understand the exact cost of using that line to be able to, let's say, cover payroll, or if you want to use some other kind of money that might be a little bit cheaper. Lines of credit, you'll pay interest every month. If you've actually borrowed some money, you'll pay interest every month. So your interest statement will come in, or your bank statement, or your statement on your line of credit will ask you to pay the interest that is owed on what you borrowed. So with that, it will just be a tiny portion, and then you can pay back a big chunk, or you can pay back in installments, however you prefer to pay back the line of credit. That's up to you. Okay, now one really important thing to note about lines of credit is that the banks typically don't like you to use all of the money that you've been allotted for a really long period of time without paying it back occasionally. So they like to have the line of credit rest. This is called letting the line of credit rest. And that's where you're not borrowing on the line of credit. So that's why the lines of credit are really good for these short-term needs. They're not great if you have a really big capital project, let's say, that you're not gonna have the cash to repay it anytime soon. Maybe you need to go loans, and we'll talk about that in a minute. You need to understand how much your bank likes you to have it rest. And they see that as kind of like, the bank sees that as, healthy use of a line of credit is being able to be solvent enough, have enough cash flow that you can borrow and then pay it back and borrow and pay it back. Because that's really what the purpose of that is really just to help you with kind of some short-term cash falls. Or cash shortfalls. Now with a line of credit, you're also going to pay an annual fee to be able to have access to this money. So typically that's going to be somewhere around $500 a year. This is not anything that's too huge, but it's something to consider when you're trying to make a decision about what you need. Okay, so let's sum up the difference between loans and lines. So with loans, you get your money up front, you have monthly payments of principal and interest. Your loans get repaid in a set term. Typically, these are secured by something like if it's a car loan, you have a car that's kind of securing it. That's the collateral. If you were to buy a building, you'd have the building secure the mortgage on the building. And if not, you might have to get like a guarantee. The owners might have to actually guarantee the loan, because if you defaulted on the loan, they want to know how they're going to get their money. With loans, you cannot borrow again after it's been repaid, and you will have an amortization schedule. So on the lines, you can borrow the money as needed. You can repay the money whenever you want. Monthly payments are going to still be made, but they're going to be interest only. There's no set term. These can also be secured or unsecured. It kind of depends on the size of the loan. They will usually need to be guaranteed by something if the line is kind of high. And then you need to let the line rest, and that you will not have an amortization schedule for a line of credit. When do you use one of these things versus the other? I would say loans are really great when you have a longer term need for the cash and that your return on investment is going to be longer. So let's say you buy a piece of equipment in your business and you're like, hey, this is going to help me sell more jobs. It's going to help me be more efficient. It's going to help us, potentially be more profitable in the future. A loan might make more sense for that, especially if it's going to take a couple years to really see the fruits of that labor or the fruits of that investment actually come back. So with that, you might decide on maybe a 3-year equipment loan, something like that might make sense. Let's say you're also looking at expanding your business and you want to make a big investment and maybe you want to buy another business, for example. You might want to get a loan for that because it might take a while for that business to start producing the cash to be able to really pay off any significant amount of a loan, but it's probably making enough business or making enough money or cash flowing enough to make the payments on the loan. So a lot of times business transactions are done with a loan, and it's really because of that longer term need for the payback. Okay. So I think when you think long term, you're probably going to go with a loan. If it's a short term need for cash, we're probably going to move more into the line of credit. So lines of credit are really great for things like I mentioned earlier, covering a payroll if you're waiting for invoices to come in. Another thing that they're really great for is if you are an inventory business and you are buying things ahead of time, knowing that you need to be prepared to sell them in the future. So we have some e-commerce clients, for example, and the end of the year is their big season. Q4 is their big selling season. And they need to buy all the inventory and have it on hand in order to fulfill all those orders and make their customers happy. They can't wait for the customers to buy the money and then buy the inventory. That just won't make any sense. So line of credit is perfect for that, where you can buy everything you need, have it on hand, and you're going to turn that into cash within a couple months and repay the line of credit. And obviously you're going to have money left over because you built profit into your business, right? That is a really awesome way to use a line of credit. And I love every business to actually have access to a line of credit. You might have loans, but having access to a line of credit is something that I highly recommend to all of my clients. And it's really even if you never, ever have to use it, it's nice to know that it's there. Okay. It kind of gives you that safety net feeling of if something happened, I would have the ability to draw on it. And the last thing I'll say about lines of credit is that try to get them when you don't need them. So when you have cash is a great time to go to the bank and ask for a line of credit. And it's something, again, that You can use a little bit and then pay it back. The bank likes to see that you're using it at least occasionally. You hold it into your checking account and then pay it back. But having a line of credit can be a huge lifesaver in, the unexpected. So hopefully that answers a lot of questions for you guys. If you have any questions specifically about loans or lines of credit, let me know in the comment section below. Hopefully this is helpful to you all. And also let me know what you think about this. Okay, I'm gonna be working on it. There's gonna be some plants, there's gonna be some more stuff, but I would love to hear your feedback. So thank you so much for being here, and I will talk to you later. Bye.